Peter Solomon is the chairman and founder of the Peter J. Solomon Company, one of the leading independent advisors on Wall Street. So, Peter, here's the question for you, and I think I know where you're going with this one. Should banks be more, and this dovetails so well with the conversation we just had with Don Kopecky, should banks be run more like J.P. Morgan, universal banks in commercial banking, retail, credit cards, and investment banking, or should they be more like Wells Fargo, or perhaps the direction that Royal Bank of Scotland is going in, less investment banking, more of a focus on the utility-like businesses?
Well, if you're the government, as your previous guest said, if you're the government, you'd like them to be run more like utilities. Banks are fundamentally utilities. They provide credit and they provide liquidity, and that's their role. They get into investment banking because it's more lucrative than just playing the spreads of deposits, the deposit spread. So that's why they went into investment banking, and that's why they went into trading, and that's why they went into derivatives. And there's a good argument that it's great to be scale, but Citibank is the classic illustration of that argument taken to the nth degree. And that's a failed model.
But not every bank has to be, not every investment bank has to be run like a casino.
Well, you're now saying investment bank.
Well, inside a commercial bank.
Ah, yes. You see, commercial banks were commercial banks, and the grass was greener on the other side, so they decided to become investment banks. When they got to be investment banks, they then got the law changed. Again, the Citibank changing the law, Graham Leach Bliley after Glass-Steagall, so they could become an insurance company. So you can carry this to the nth degree. The nth degree got us into a lot of trouble.
So those who would favor the universal model, and again I'll cite J.P. Morgan and Jamie Dimon, would say that if you manage your risk properly, you can do both. Do you believe that ultimately, even if one bank can do both, it's impossible for all banks to do both?
It's a question of management. And I think management shown what the history is, despite the Harvard Business School and Yale School of Management you were talking about earlier, managers aren't sufficiently skilled. There are not a sufficient number of skilled managers to manage the number of people.
Really?
Yes.
Oh, the MBA schools and all the other schools of professional management in this world aren't pumping out people capable of running these institutions?
Well, they are, but apparently they're not going into investment banks or commercial banks.
But doesn't that have more to do with the way that these people are trained, the way that they are, I guess, I wouldn't say brainwashed, but the way that they are taught to behave inside these banks? Maybe somebody needs to come in from the outside. Look at Bank of America. It's been a tough slog for Brian Moynihan. And there's talk now that maybe if B of A is going to be run differently, you have to go somewhere else entirely to find that person because he might not even be inside B of A.
Sure, but Brian's done a very good job and is setting his mind on this course. Jamie's done a very good job. Wells Fargo's done a very good job. It's hard to do a very good job in this. One of the reasons I would argue, of course, is the casino was rigged the wrong way. When the business was those are proprietary businesses, when they were partnerships and it was your own money in the risk-taking business, you had a different idea of risk. I always said that the partners of Lehman Brothers in the very old days, when they spoke Dutch, all sat in one room on the third floor, not because they liked each other, but because they wanted to hear what their other partners were committing to. So it's a question of risk. And in a limited partnership environment, using other people's money, you'll get the same effect you'll get in a casino.
Peter, I can't wait to hear more from you. We're going to take a short break, everybody. That's Peter Solomon of the Peter J. Solomon Company, one of the leading independent advisors on Wall Street. Peter Solomon, chairman and founder of the Peter J. Solomon Companies. We are talking about Wall Street. Peter, casino versus utility, a lot of it has to do with incentives, the way people get paid. This is payday time on Wall Street and at the European banks. What everybody wants to know is, have things changed enough so that people aren't being incentivized to take crazy risks? They're being rewarded for delivering returns to shareholders in the right way. What do you think?
I have no idea whether they are because I'm not within those banks. But they have to change the incentives. They simply have to change. The government tried to change the incentives by all sorts of legislation and fiats. But actually what happened was interesting. The banks ended up paying back TARP funds, and I think one of the reasons they paid them back was to get out from under all the pressure on compensation. I don't think that benefited the United States or anybody else by repaying that instantly. Then they needed to go out and raise equity again. They're trying to build up their equity now. So I don't think there's a fundamental change.
Peter, you know as well as anybody what bankers expect. You worked for years at Lehman Brothers before you set up your own firm. Why is it, whether it's 50%, 45%, 44%, 42%, bankers as a group feel entitled to this gigantic share of a firm's revenue?
Well, I tried to see whether Galileo or Newton had said anything that, any reason that bankers should get, or employees in total should get 50% of the profits of a firm.
A law of the universe.
A law of the universe. It didn't seem to occur. It was established by fiat by the banks. And they simply said they were going to pay 50% of their comp. They were going to take 50%. The shareholders would get 50%. I have no idea where that came from, and that assumption should be under a lot of pressure.
It's dropping, so maybe the pressure is there, and perhaps having some impact right now.
Well, it has to have some impact. It's amazing how passive shareholders are on that subject. They're now just getting upset. But you haven't seen many shareholders really rise up and rail against banks on this issue.
Shareholders perhaps not, but people in the streets, yes.
Yes,
think about Occupy Wall Street.
Sure.
What, in your mind, must banks be doing, should banks be doing for the sake of this economy right now?
I think run serious operations, which I think they're trying to do. You know, they have an enormous problem. They have an enormous overhang of loans and assets that probably aren't worth what they're on their books for. That's why the stocks of many of these sell at 40 or 50% of book value. A couple of them, like Wells Fargo, sell above book value, but it's very rare. So they just have to run serious businesses. I think they are trying to meet loan demand, but at the same time they're meeting loan demand, as somebody said earlier on your program, they're not holding loans. The bond markets are bailing them out. The hedge funds are bailing them out. They're not holding. When they make a loan today, it's really the bond market that's taking over from them, becoming more agents.
All right. The agency model returning perhaps to Wall Street.
It would be a good idea.
Who would know better than what it was once like than Peter Solomon? Peter, great to have you here. Look forward to our next chat. Peter Solomon of the Peter J. Solomon Company, one of the leading independent, it's so important to emphasize that point, independent advisors on Wall Street, not prisoner to some